Good evening and welcome to today's webinar on this very sticky evening. This is our guide to everything you should be considering from a financial perspective when you're faced with redundancy or if you're negotiating a leaving settlement. Before we get started, just have a look on the screen. You'll be able to see on the left-hand side a Q&A button. If you'd like to ask any questions at all during the presentation, please do. I'll answer anything as I can all the way through or at the end, depending on what they are. Okay, let's get started. As a brief introduction, my name's Rebecca Aldridge and I am the founder of Balance Wealth Planning. I'm a chartered financial planner, which in short means I know quite a lot of geeky technical information about all things financial. Most importantly, I've got a holistic planning approach, which means that I always take the stance that money is valuable, not just in its own right, but because it provides us with security, experiences, and the ability to support people around us that we love. We all know that money is important, but at the end of the day, it's just a resource which enables us to have the most comfortable, rich, and interesting lives that we would like. We've been recognised quite a few times for our planning approach. We're regulated by the Financial Conduct Authority and we are independent. So there's all the formalities out of the way and we can get started. So in this evening's session, we're going to talk first about how to stay positive when you're being made redundant or negotiating leaving terms. I know it's not a nice topic, but I think you'll probably know somebody who's been made redundant in recent years or been in that situation yourself. So we need to tackle it. And if you don't know anybody that's been in that position, perhaps it might be something that you are worrying about as well. We'll go through how to adjust to your new situation and plan ahead for the first few months and then beyond that. We'll then spend some time looking at the detail of how redundancy and leaving packages are usually calculated and structured, including how they're taxed. And we'll also touch on some of the most common financial planning steps that we recommend. We'll also give you some actions to take away at the end. So let's get going. When you first learn that you might be made redundant or have to leave a business that you've been in for a long time, it can be a huge shock. Our role at work is such a big part of our lives. For most of us at work, we're challenged and sometimes put under pressure, but it often brings a sense of achievement and satisfaction. It's where we learn new skills, develop good friendships, and of course, we earn the money that we need. What often happens when the bad news breaks is to feel a sense of shock, quickly developing into denial. A feeling that this can't be happening to me. And then as the realization sinks in, you become frustrated with your lack of control over the situation. Perhaps you're angry and miserable. Your mood and your belief in yourself could drop and it could be difficult to think about the future. But there has to be a turning point and gradually most people turn and start to accept and engage with the new situation they're in. And perhaps, to their surprise, they might find there's some positives, maybe even some opportunities. If you're in this position, you might find that this new situation forced upon you has actually done you a favour and helped you take a step you might otherwise not have thought of. It's important to remember through all of this that it is not a criticism of you as a person. It's your role in the organisation that can't be supported anymore. It's not your fault if you are made redundant. Your confidence might take a big knock, but you still have all the same skills, expertise and experience you had before. Just because you might not be contributing financially to the family or household for a while doesn't mean that anyone will be thinking any less of you. You now have an opportunity to choose what to do next and how you'll be putting all your skills and experience to good use. So let's think about planning for your short-term survival. Most likely the main thing you'll be worrying about to start with if you're in this situation is how are you going to survive financially? To tackle that, you need a clear financial plan for the short term that you can stick to. And here are the 4 key areas to look at. The first step I always recommend is to identify what income you'll have after you've left work, assuming you don't have a new role lined up immediately. Your change in circumstances means that you could be eligible for certain state benefits, the main one being job seekers allowance. For an idea of what you could apply for, you can check an online benefits calculator. My view, though, is that it's much better to rely on yourself and your own savings rather than any benefits. If you get benefits, look at them as the icing on the cake. Secondly, look at your spending for the last 3 months to get a good understanding of just how much your essential outgoings are each month. So that's things like mortgage repayments, utility bills, vehicle running costs, and so on. What are your other normal outgoings? Write absolutely everything down. We all spend more than we realise. Scrutinise your list, work out what is essential and what is not. Where can you make savings realistically that you can sustain? Maybe cancel the gym membership, cancel the TV package. You can really cut out quite a bit on a short-term basis. Remember, these are just until you get yourself sorted out, so it doesn't have to be everything. You could cut back on things like regular dinners out or weekends away. You can even cut back on things like investments into your children's junior ISAs or even your own pension contributions. This is just a short-term step until life settles down again. Thirdly, have a look at what you have in savings and investments that you could access at short notice. If you're over 55, you can look at your pensions too, because many of those can be accessed from that age. Don't forget then to take into account any package or settlement you'll be receiving. How much do you have? How long is this going to last if you need to live off it for a while? Which would you use first? Lastly, go through your insurance policies. Look out for any payment protection insurance or mortgage protection insurance policies. They're also called PPI. It wasn't all about the scandal. These PPI insurances actually can be quite valuable. They're usually attached to loans, credit cards, or mortgages, and they're designed to pay the interest on those if you need to make a claim because you've been made redundant or if you're ill. Also, check if you have something called accident, sickness, and unemployment insurance in place. If you do, now is the time to contact those insurance companies and tell them you've been made redundant and you need to make a claim. Be prepared to give them evidence and check with them what their waiting period is. Most plans will have a minimum waiting period before they'll pay any income out. But once payments start, they will start to pay out an income to you for up to 2 years usually, or until you return to paid work. So from this short-term exercise, you should be able to see what income you have coming in from you, benefits, other members of your family, for example, what you need to spend, what income you need to cover your spending and to support you and your family in the short term. So having thought about this short-term fix, we can then start to think about what comes next and new possibilities. Most people who've been employed with the same company for a while become comfortable in that position. And while it may not be an ideal job, natural human inertia stops us from taking any action to change things. Being made redundant could be the catalyst for making a change for the better. So now is the time to think quite deeply about who you are and what you value. Did your current job really represent who you are? Did you enjoy it? If yes, perhaps you're considering a new job doing much the same thing. Or you might want to have a change of career, something completely different, a role that you'd find more fulfilling than the one that you've just left. Another option might be to start your own business and do something you've always dreamed of. Perhaps this is the opportunity you've been waiting for. Or, depending on the settlement you've received and your overall wealth and your age, you may be in a position to be able to stop paid work altogether if you want to. Working with a professional financial planner to explore all of these options can be really valuable. There's a couple of key reasons. Firstly, A professional planner can show you a forecast of your wealth now and over your lifetime based on different scenarios. Seeing a wealth forecast in front of you based on you getting a new job, investing in a new venture, or stopping work altogether, whatever the options are, it can be hugely empowering and allow you to really see what's possible and what's affordable. Professionals tend to use bespoke tools to forecast wealth and test out different scenarios easily. That's what we do. It's not impossible to do it on your own to get a rough idea, but it's a bit more challenging. Secondly, it can be really difficult to think about what you really want in life and what you value. It's not something we naturally think about very often, and nor do we usually have the luxury of someone listening to us who's interested in exploring things with you and who understands finances. As a professional planner, we're trained in doing exactly that. So if you feel like you need more support, we're here. So how much can you expect from a redundancy payment? To receive statutory redundancy pay, which is a legal right, you must have been working for your current employer for 2 years or more. You'll be entitled to pay depending on how long you were working there and how old you are. If you were made redundant after April 2018, your weekly pay is capped, and the maximum redundancy pay you can get is £15,240. But some employment contracts are more generous than this. So you need to be aware of what your contract says, not just what the statutory position might be. In any case, when you go through this process, your employer will tell you what you're entitled to. If you're not being made redundant, but you're negotiating a leaving settlement, it's common to agree anything from 3 to 18 months worth of pay, plus unused holidays and benefits as your settlement to leave the company, no questions asked. The amount that you negotiate will depend on your notice period and your salary, among other things. It's very much a negotiation. So how does the tax work? The first £30,000 of any settlement you receive is usually tax-free. Any redundancy pay above £30,000 is usually added to other income for that tax year, and it's going to be subject to income tax and national insurance. Your employer will deduct that for you automatically when they make the payment. Other earnings, like things like holiday pay, unpaid wages, bonuses, and overtime pay, they're all tax-like earnings as well. Now, the tax can be really significant if you're receiving a large amount. We'll be touching on how that works and, very importantly, how to reduce it in a moment. So your employer should deduct the tax for you, but there is a possibility that they won't have taken off the right amount. Now, this isn't their fault. It's because of the way the tax system works through the inland revenue, and it's based on the assumption that we get paid the same amount every month. When there's a large payment in a particular month, the inland revenue systems suddenly think that you're going to receive that every month, and they tax you accordingly. So that usually means you going into a higher or even an additional rate tax bracket, having more tax deducted, perhaps incorrectly. Everyone's situation is different, and you may have a fairly good idea about whether that tax issue is going to apply to you. Otherwise, you can speak to a professional about it for advice. The good news is that if you have overpaid tax, that can be reclaimed quite easily by contacting HMRC directly and explaining the situation to them. Or if you want to wait, you can complete a self-assessment tax return and it will be refunded through that. You can do that yourself, or you can ask an accountant to do it for you. If you're not sure, ask an accountant. It will be a good investment, perhaps just a few £100s for them to do that for you for that particular year. Bear in mind, there's also a chance the tax deducted could be too little, and it's up to you to notify HMRC if you think that's the case, and be aware that you might be asked to complete a self-assessment tax return at the end of the tax year to pay any additional tax due. I recommend, if you're in this position, trying to get a good idea of what you'll receive after tax on your settlement, and then that way you'll be avoiding any nasty shocks or disappointments. Your employer should be prepared to help you with this. If your employer is of any size with a meaningful HR department or perhaps an internal accounting function, they should be able to tell you exactly what tax you'll be suffering on that payment. Don't forget that non-cash benefits that form part of your redundancy package, so things like a company car, they are also given a cash value and they will be taxed accordingly if that's part of your package. So tax is a big issue, and you will probably have paid a lot of tax on your redundancy settlement, with the exception of that first £30,000. If you want to claim back some of that tax, most people start to turn to pensions as a solution. Making a pension contribution attracts tax relief. In other words, when you make a pension contribution, the tax you paid on that money when you earned it will be given back to you. Some is given back into the pension itself, and some is repaid to you personally. If it's quite a generous settlement, you could be easily paying 40 or 45% tax on that settlement you've received. So being able to get that back is extremely attractive. But it does mean you have to put money into a pension, which you can't necessarily get money out of quickly again. Once you make a pension contribution, the money in your pension fund can be invested, and from there it grows tax-free. And then when you eventually come to take out your retirement benefits, 25% of the fund can be taken tax-free, and the rest is taxed like income as you take it out. So there is lots to like about putting money into a pension, but there are limits that apply. And they're tricky. Generally speaking, most people can pay in 100% of their earnings, or £40,000 a year if that's less. But if you haven't made substantial pension contributions in the last 3 years and they've been under £40,000 in value, that cap could increase. You can essentially carry forward some allowances from previous years. It is tricky. It's really important also to be aware that timing is everything with this. You are allowed to make a pension contribution at any time during the tax year based on your earnings in that year, even if you are no longer employed. So if you earned £60,000, for example, and you had enough pension allowance, you could make contributions worth £60,000 at any time this tax year. If you wait until next tax year, it's going to be calculated based on next year's earnings. And if you're no longer employed then, or if your earnings are lower, that opportunity is lost. So making pension contributions in the same year you are made redundant is usually a good idea. But to be clear, you do not need to make pension contributions before you leave employment. It just has to be in the same tax year. If you choose to, you can make a contribution into your workplace pension if you have one, and if it's a defined contribution sort of pension. Or you can set up a new personal pension of your own if you prefer. The tax position is the same either way. So let's think about what to do with that money after you've received it. If a pension is not right for you, or you're limited in what you can pay in, there are some other options which are tax efficient. An independent financial planner can help you, and this is the sort of thing we often explore with our clients. ISAs are a good starting point because they're tax efficient, but it's important to think about what the money will be used for. If you don't need it, investing might well be a good idea for you. If you're likely to need it, or if you're not sure, the best thing to do is usually to put it in a savings account with the bank, being careful not to put more than £85,000 in each account. If you think you might need to live off that money for a while, you'll need to have easy access. Putting it into a pension is not going to be helpful there. Equally, if you're thinking you might need it for a project or a venture, perhaps a new business idea, You need to keep that money in cash while that happens, and then see what you have left when the project has advanced a little bit. Don't overcommit, I guess, is what I'm saying. Keep some flexibility, particularly to start with. Lots of people consider repaying something off their mortgage or credit cards, and that can be a good idea, but of course, it's another situation where once that's done, you can't ask for the money back very easily. So just check that you are in a strong and stable place financially before you make that commitment, and you've got enough flexibility with other savings that you can turn to if you need them. Also, just have a think about the interest rate that you're saving on your mortgage and ask yourself whether that's the best thing you can do with your money. I've seen many, many mortgages where you've got fantastic interest rates of perhaps less than 1% a year. You know, investment growth within a pension might typically be at least 4 or 5% a year, if not much more. So repaying debt more aggressively than your original plan sometimes isn't the most attractive thing to do. Let's also think about the benefits that you had with your employer that maybe you will have lost. So many employers provide their employees with valuable additional benefits like death in service life cover, private medical insurance, and maybe a company car, as well as others which you'll lose when you leave. If you don't have a job lined up with similar benefits, you might want to arrange replacements yourself. You might want to take out your own life cover, for example, and your own private medical insurance, for example. You might also need to buy a new car. You'll need to factor that into your thoughts about the settlement you receive and what you do with it. You will need to ensure that your family is protected if the worst happens, but you need to be sure that you can pay for it. So before you go and set up some life insurance policies, be aware there are lots of different types, and it's useful just to have that conversation with a financial planner first to make sure that what you think you need is what you need. We don't want you taking out insurance policies that might be expensive when you don't actually need them, even if that does replace what you've lost through your work, like for like. We can work out exactly how much cover you actually need. You might need more than you originally had through your work, but it might be that you need less, or perhaps you don't need any cover at all. So let's turn to thinking about shares and share options. If you've worked for a big company, you may have had share options of different types, or shares in a share save scheme, or maybe something like an employee share ownership plan. They can be really quite confusing with different categories of shares and quite complicated tax treatment. My main message around this is that you'll have limited time to exercise any options, so the options to buy shares. You'll usually have a 6 to 12 month window to do that. And if you don't exercise your options in that time, you will probably lose them. But before you rush to exercise them, check whether the option price is attractive, check whether you want to buy these shares, and if it's valuable to you, and if you need that money for something else. It's not always the best thing to do, so just take care not to make a mistake with exercising those options that can't be undone. You might also have shares in the company itself, and you'll need to decide whether you want to keep them or not. The choice is yours, but just be aware of the tax that could apply if you sell them. Depending on how the shares have been accumulated, there could be income tax or capital gains tax to pay. So just be aware that they often come with a tax issue. They're easily resolved, so often an accountant or a professional advisor can help you minimise that tax, but it's a good idea to just run it by somebody before you press the button. You are also likely to have a pension plan that you accumulated with your old employer. Now, my main message here is that you don't have to do anything with this straight away. It's not going to go anywhere. But at some point, you'll probably want to review your pension options and take independent financial planning advice. You will have several options available. One of them is just simply to leave the pension where it is, and that's fine. Another would be to transfer the money into your new workplace pension, or you might want to transfer the money to a personal plan if you have one. If you're over 55, you might even want to start drawing out a pension income. So there's lots of things that you might be considering. But again, just because you've been made redundant does not mean that you have to suddenly move your pension somewhere else. If you are lucky enough to have a defined benefit pension, you will be told probably a few weeks after you've left what your pension is worth. And that's going to be expressed as an income that you've built up until the date of you leaving. You will be able to keep that exactly where it is until you want to retire, or you can ask for a transfer value. And the transfer values are usually a lump sum, which are anything between perhaps 20 to 40 times the amount of the pension. But taking that does mean that you give up the regular guaranteed and secure income that's part of the scheme. Most people leave these schemes exactly as they are and start taking the benefits from them when they retire, but other people choose to take the transfer value. It's a complicated area of planning, and you have to take advice from a specialist before anything can happen with that type of scheme. So perhaps you might be thinking about a new venture of some sort. After all, we said earlier, this redundancy situation doesn't have to be a negative one. While some people might be looking for a new role or perhaps retiring altogether, you might be thinking about something different. There is a lot of support available to people wanting to start up their own business, ranging from local chambers of commerce to specialised business consultants. If you're thinking about that, I would say the first thing to start with is to have a well thought out business plan. It's the most important ingredient for success. Spend some time thinking about how much you would need to get your business off the ground, and then probably double it. Cash is vital. So if you've got a pot to invest into getting set up, that will be really valuable for you. Make sure that you've got enough money to pay the bills and keep yourself going, set up the website, whatever the things are that you need. Make sure that you've got enough money to live on and pay your own bills before you start generating any income from this new venture, because it could take months and months for it to actually do anything. I would also just have a check-in with yourself about whether this is something that you've always wanted to do and something that you're well equipped to do, or whether it's a bit of a romantic vision that actually when it comes to it, you don't really want to do. So, really reflect on whether this is something you can picture yourself being successful with. It can be valuable, again, to talk to a financial planner, because we can use those forecasting tools to simulate what would happen in different scenarios. So what happens if you perhaps set up a new venture and it doesn't earn you any income for the next year? We can help you see where your money's going to come from to pay the bills, and also how long you can last before your business starts to generate some profits. So let me go through some actions for you to take away. Firstly, I want you to think about checking on your redundancy package and how it's going to be taxed. Then look at your budget, your income, your spending, and think about a short-term plan so that you can try and make ends meet as much as possible for a short period of time until you have something else that's going to come in, perhaps new work, a business, or perhaps you're going to retire altogether. Look for insurances that you might have, payment protection policies or accident, sickness and redundancy policies. And if you can find one, make a claim. They're valuable and they're unusual these days as well. So just check if you've got one. Also check what state benefits you'd be entitled to. Look at your savings, your pensions and investments and see if any of them can be accessed without penalties if you need that money to live on in the short term. Then think deeply about what you really see yourself doing next. And if you're not clear, or if you need more technical advice, speak to an independent financial planner who specialises in holistic planning, so we can look at the whole position. And I would add another one onto this list, in fact, to think about how you can minimise the tax that you will pay on your package. So we've reached the end of this whistle-stop tour through what to do if you're in the unfortunate position of being made redundant or needing to negotiate a package settlement of leaving. If you would like to ask me any questions, then have a look at the Q&A box on the left-hand side of your screen and pop down some notes on there. I'll answer them right here. I know there's only a few people on the webinar this evening, so that's fine if you don't want to ask any questions in this forum. You're very welcome to contact me directly or any of my team. If you need any advice personally, you can contact any of us via our website, so it's balancewealth.uk, and in the top right hand side of the site you'll see that there's a link to book a meeting, and you'll be able to browse and find the right person for you to meet up with. Okay, so I'm just going to check whether there's any questions that have come through. There's no questions today, so that's all fine. If you do think of anything that you want to ask after this webinar, please just send them through by email, that's fine, or your usual contact. So I will leave you to enjoy the rest of your evening. It's been a pleasure going through all of it with you, and I hope you have a pleasant evening and good night.